Hi, everybody. Welcome to this summer investment and economic update. It's Melissa Joy here, and I know many of you are attending. Thank you for RSVPing live, but also many of you will see this in a recording function. This is being recorded in July 2024, and we've got a lot to talk about. Just to remind you, if you haven't been to one of our presentations before, we like to focus on what's real and what we see happening in the market versus speculation, fear mongering, over optimism, overconfidence. This is a chance to reset and see what's actually happening versus, kind of future planning that doesn't have a lot of foundation in process. And so we always like to be starting from a place of reality and optimism. And I think we have a lot of good things to discuss today. We will have time for Q&A, and one of the easiest ways for you to ask questions is to just put it in to the Q&A, and then I will address those at the end of our conversation. So without further ado, here's me on a good day, but talking about summer economic webinar. And I want to let you know that I am founder of Pearl Planning, and we are a financial planning and wealth management firm located in Dexter, Michigan, serving clients around the country. Today, we're going to be talking about the economy, investments, the election, which is obviously going to be a growing part of our conversation for the next 4 or 5 months, and then important long-term investment wisdom that I think is quite relevant today. We always try to remind you about the age-old investing adages that have really helped me to be an investment professional and help our clients have success over time, as well as some reminders on financial planning considerations. And then, like I said, we'll be happy to address specific questions that are important to you, either at the end of the presentation, or you can follow up with us with an email. So let's talk about the economy first. It's interesting because a lot of our country feels, if you were to survey people, regardless of where they are, like things should be better. Things are not going well. People are unemployed. There's a lot of negative sentiment out there. And certainly some of that is justified, but we also want to ground things in information that we're seeing, specifically from age-old data sets of what's kind of going on in the economy. Today, job openings are continuing to fall from record highs. If you can see in the top chart, the purple line is a look at unemployment or job openings. The purple line is a look at job openings, and that peaked, of course, is COVID, when everything was disrupted. So those are continuing to decline, but they're still well over where they were pre-COVID. And the U.S. employment rate has ticked up just slightly, but is still near lows for this time frame. Labor participation rate remains low, but it has come back up off of the troughs that we had in 2020, which were really generational lows. So I think that is probably going to be persistent because our population too is aging. And so many of the people unemployed are kind of considering being more fully retired just because of demographics that we have occurring, but certainly not signs so far of a recession. The recessions are those gray lines in both of these charts. And so just to note that we don't see the uptick in unemployment that you would typically see in a recession. Also, GDP, that's a measurement of growth, not perfect, but important. We have two sets of lines here on the top. We have both just unadjusted gross domestic product, as well as real GDP, which takes inflation into consideration. And when you look at both, there's still a trend toward growth. You see that this is not falling off a cliff. It's certainly been less volatile than it was in early years prior to the early part of COVID. But even as you adjust for an extraordinarily high inflation rate more recently than we've experienced for most of the last 30 years, you see that GDP continues to grow and doesn't seem to be thus far falling off a cliff. Meanwhile, mortgage interest rates continue to remain high. So when you are looking to buy a house, if you're looking to borrow, then you may choose to stay home if you already have a mortgage at lower interest rates. There's just a lot of people that are locked in to their previous low rates, which is causing an issue when it comes to housing inventory. And yet home prices are staying high, even though many predicted that these higher interest rates would start to kind of tumble when it came to housing prices. And a lot of that has to do with inventory. It's a good reminder because I think that people a year or two ago were just saying, oh, first of all, interest rates were likely to be falling quickly. That is just as unpredictable as investment markets in general. So be careful of those kind of predictions that sound like they are firm and solid and 100% going to happen. But also, we just haven't had housing markets that are like this. And so we are going to experience different outcomes potentially. And that's just something that we need to be familiar with and aware of. And when it comes to our planning, what we do with that information is we plan with the information that we have today. If you're going to be buying a house, we wouldn't assume that next year you could do a refinance and cut your interest rate by 2%. But then we will adjust based on what the world is giving us. If you're a saver, those interest rates are great for you because you're getting paid a yield on your money market. If you're a borrower, then it can be quite painful. And so, we'll all experience different types of rate environments over our lifetimes. Likely for most of us who are borrowers and have mortgages, will have different interest rates and different notes over time. And we just need to kind of be realistic when it comes to these things. But we just did a podcast episode about mortgage interest rates this week on our Women's Money Wisdom podcast. And I'll tell you, it's still, people are still borrowers in this environment. It's quite interesting. Okay, let me get my screen out of the way here. Okay, so inflation, certainly on everyone's mind. The thing I like to remind people about inflation today is that when inflation comes down, that does not mean that prices go back to the price that they were in the past. So we definitely are experiencing a situation where inflation has become more measured. Certainly one of the last areas to kind of fall is housing in terms of those prices. But even there, we're starting to see some median prices that are moderating. But that said, inflation is just kind of all over the place when it comes to different segments. So for example, we had a peak holiday weekend for vehicle travel, and gas prices were, you may be surprised by this, but lower than they have been for the last couple of years in this peak travel season. Meanwhile, other components of the economy may have higher inflation. And so we're seeing this even with pockets of parts of the country as well, where people are talking in Austin, where the real estate market was very hot post-COVID, where things are moderating. But if you are in Michigan and looking for a house, you're likely making offers that are well over ask price to get them in some of the more attractive neighborhoods, which we're experiencing for clients, both on the attempts to purchase as well as, fortunately, for their attempts to sell property. So with inflation comes some education because we haven't had such high inflation rates in the past. Also, that is creating these longer periods of time where interest rates remain higher. So that is certainly interesting and different than what we've had over the last decade, or dare I say 20 years. And so, inflation remains higher than it was before 2020. And certainly that will likely be remaining an important story, and one that is frustrating to consumers, and probably is a big portion of that dissatisfaction with the state of current economy. It doesn't feel good when prices are higher. And it also feels like you can't control that. So there's some emotional impact that certainly is valid. But I do think that this function is kind of going into how people feel about, oh, the economy is not good. Anecdotally, though, it's interesting because here's some other, kind of data that we have about what's going on in the economy. Airport traffic. So if you were to look at last week, still, again, peak travel is happening consistently. When you look at numbers from the TSA, they actually publish how many people are moving around the country on particular days, and they compare it to the year prior. it still seems to be like there's more demand and more people are hitting the road. And when you look at these charts, it's really interesting. You can see from 2019, pre-COVID, is the navy line. The light blue line is last year, and then this year, hey, people don't get on the road when they aren't able to pay for their trips, and it just seems like consistently we didn't think we could go higher, but here we are. Also, data set that has been adjusted and goes back to the 1990s indicates that people are less levered in terms of how their balance sheets than they've been in the past. Now, people may say, no, the absolute numbers of borrowing on credit cards, on mortgages, etc., is higher in absolute terms, and certainly it is. But when you look at the amount of leverage, that also includes people's cash on hand, their retirement accounts and investment assets. When you look at their full balance sheet, they have borrowed less as a percent of their overall net worth than in the past. And this goes across and across kind of income areas. We are not at peaks. And so that's also interesting anecdotal data. In spite of all this, people just they do not like the US economy right now. And we have more data on this, especially because it's an election year and this plays into how people vote. So people are very interested in studying this, but I see persistence regardless of what's perceived as a state, blue versus red. Everywhere around the country, people think that their economy, their local economy is doing well, but the state of the US economy is not doing well, and they believe the economy is shrinking, which that's another way to talk about being in a recession. More than 50% of Americans, based on a Harris Guardian poll, believe that the economy is shrinking in spite of the growth in GDP that we just showed you. 49% of the country believe that the S&P 500 is down for the year, which we'll get into those numbers in a moment, but that's just not the case. And then also 49% believe the unemployment is at a 50-year high unemployment rate. In fact, the unemployment rate is much lower than it was a few years ago. Then we have the outcome of this study, which is talking about the election and Biden's responsibility, President Biden's responsibility for this in terms of the economy. I'm less focused on whose accountability this is, because I don't think actually, in many cases, that the person running the executive branch is responsible for much of the machinations of the economy. We can't give any president the reward or credit for creating artificial intelligence, which has driven much of the growth of the S&P 500 this year. I'm just more curious about how it affects us in terms of our decision making as investors. And so I want us all to be aware of this disconnect that it may feel better locally, but not good nationally. And I love this Simpsons reference. Have I been wrong about the economy? No, everybody else in the data is wrong, because I know what starts to happen when you go back through the numbers that I just mentioned on the economy is people start to parse and parcel, hey, that's good data versus bad data. I totally get that. You can pick and choose when you're creating a narrative about what's going on. I think focusing on things that are primarily age old, kind of data points that are created in an economic setting that is reported through administrative institutions, universities, and the government. I think that consistency is really important. So don't focus on the narrative that's being created in by somebody trying to sell you investments, perhaps selling on fear. Same goes when it comes to your preparation for the election. I think focus on the election beyond the economy, because it's just not something that politicians are responsible for creating as much. So let's talk about investments. Okay, here's how we're actually doing year to date. These I think are numbers that are unimpeachable. This is just what's actually happened in the rearview mirror. I included the NASDAQ index because that is the growthiest, largest company, technology part of the economy. which has just been the key performance driver, not only in the last 6 months, but over the last 5 years, a really important part of investment results. And then we have our traditional, for most people, index that is used to measure US stocks, which is the S&P 500. It actually is an index that includes large companies primarily. And so we have a very different story. First of all, that NASDAQ and S&P year to date, I actually grabbed these numbers a little bit before July 1st because of the holiday week last week, but we were up 19% on the NASDAQ and we're still there or higher. And then the S&P was up 15.6%. And you may say, well, then why are my accounts not up that much? Because many of you have diversified accounts. And so then we go to the blue line, the next line in like my kind of list of indexes, and that's US companies that are smaller. And smaller US companies, while the S&P was up 15%, those smaller companies were up 0.21%. So a delta, a difference of 15% in terms of the returns of big companies versus the returns of small companies. We're going to talk about that in a moment and, kind of see what's happening under the hood. Then we have the rest of the world. And you may assume, hey, if small companies are doing bad, the rest of the world, there's so many issues going on around the world, they must be horrible. No, actually, they're in between. So MSCI World Index, excluding the United States, was up 5.5% for the first half of the year. But then we get back to bonds, and bonds just continue to struggle. Interest rates continue to nudge higher because there's an assumption that the Federal Reserve will not be lowering interest rates. And so that is just kind of prolonging the pain in the bond market. And we have bonds as measured by the Bloomberg US Aggregate Index down by 0.5%. This is in spite of those same bonds yielding around 5 to 6%. So that means that the prices went down by a couple percent while you got paid income for half of a year of 2 or 3%. And then your shortest bonds, these are a proxy for cash in terms of index measurements. Those were up 2.5%. So the bonds that mature over a longer period of time have been doing not well, while your short-term money and your cash, you can go to the bank and just get your 5% yield if you're shopping around for your money market rates. So that's kind of what's going on more broadly year to date. Keep in mind, these numbers are only for 6 months. So if you were to annualize these numbers and assume that the same thing happened for the second half of the year as the first half of the year, those are just stunningly high numbers. Things never happen exactly how they did happen. I'll tell you that. And we know that. Unfortunately, what you give up when it comes to investing is you have to understand that you can't predict. You have to pick up your returns when you can. So it would have been a very bad time period to sit out owning stocks the last year. But then we say, well, now we're at an all-time high. I think I need to cash in all my chips. And so here's a little bit of data about that. We're in a bull market, and that bull market started in the fall of 2022. I don't know if you recall, but it was not a fun time to be an investor in 2022 in the fall. We had stocks that significantly declined. And since then, we've had a change in the S&P 500. This is back in May, so the numbers are even better today. The Carson numbers on the left, lower. But since October 12th of 2022, the market, the S&P 500 was up 43%, and it's even better today. The length of this has been just about 20 months right now. And a lot of times bull markets happen to start in October. So this is just perhaps a coincidence, but it seems to be a month where, kind of things accelerate to being very pessimistic, and then you start to build a new phase. Now, the average length of time for a bull market is 57 months. Wow, let's think about what that number means. That is almost 5 years. And we are sitting here less than 2 years into this bull market. That's not to say that we necessarily, that every bull market is 5 years. It's not purely predictable, but it is one piece of data that I would take in when you may be thinking, it's time to assume the worst going forward. The other interesting thing is that on average, a bull market will have a change in the index of about 157%. The median number is 100%, but both of those numbers are much higher than where we stand today. So it's just looking at some historical information going back more than 70 years in terms of what is happening, what to expect when it comes to a bull market. Again, the other thing, and I was just talking to my dad, an average investor, retiree, about this because he said, things are really frothy, Melissa. We're at near all-time highs, so that has to be impacting how you're investing today. And I told him, and he was incredulous, like, this cannot be the case. Just FYI, Dad, the average returns to the S&P 500 when you invest near all-time highs or at all-time highs tend to be higher over a long period of time, over 6 months, 1 year, 2 years, than when you invest on any given day. But that is the case. And part of that story is just the nature of bull markets. But if you look at this data set from since 1988, over a year, if you invested in an all-time high, on average, you'd be up 13% versus 12% rounded for just any given day. I mean, I'd take both of those numbers if it were me. Certainly not a prediction of the future, but is important for you to remember that as you're thinking, oh, I probably missed it. I need to hunker down and wait, because I'd sure hate for you to be that person at the end of last year after a record year saying, I don't think I can be an investor today. And then have missed the returns that we got starting in January through June this year. Looking at things beyond that, let me get back here. Beyond that, though, I think we have to keep in mind that there still are reasons to diversify. And first, I want to tell you the cold hard facts, and I just pointed these out, but I kind of isolated some of the data. First of all, here's US large companies versus small companies. So Russell 1000 is the biggest companies in the country, and then the Russell 2000 is smaller in terms of what geek term market cap. That's how big the companies are as measured by the stock that they have out there. The large companies, like we mentioned before, up 15% or so, versus small companies just sitting there like still at the starting line halfway through the year. If you take another measure, growth versus value, most of the returns, the S&P is actually skewed toward growth, so it's a bigger percent of the overall index nowadays. It's not kind of diversified between growth and value, just everything is skewed toward growth. And these trends have not just been happening year to date, but I just wanted to isolate some numbers for what's happened so far this year. When you look at growth versus value, on the right, growth was up 21%. And those biggest, frothiest companies, or best companies, I guess I should say, to be invested in, were really a big part of that, versus value only up 6%. Even for big companies that were up on average, when you blend everything together, about 14, 15%, depending on the large company index that you utilize. I'm going to get to my point in a second about why you don't want to sell all of these investments and just put everything into large growth. Okay, so here's growth versus value over longer periods of time. The Russell 1000 relative to value versus growth first. When you look over time, and let me just show you, I started learning about investing in 1998. That's when I first got my first job in financial planning. And back in 1988, it was just like the best time it was the first dot-com bubble, but it felt really good to be investing in technology. The internet was just becoming a part of our economy. And then we had a time period from 2002 until 2009 where it just did not pay off at all to be a growth investor. So we went from the best of times, and the blue line on the bottom is the relative performance of growth versus value. When the bar is at the top, that means it was better to be a growth investor. And when the bar goes to the bottom, that means it was better to be a value investor. So looking at the bottom over this period of time, it just really did not pay off to be a growth investor for most of the decade of 2000 through 2010. And we don't want to overly skew and miss out on the possibilities and the results that we've had from growth investing. But we do think it's important to monitor your exposure to value. This can be even more important for people who are in technology companies who are receiving equity compensation that is purely in a single issue company that is in the growth sector. So just some history lessons, because during this time period, the decade of 2000 to 2010, it just really paid off to have diversification, to have things other than large growth companies. Same story, different part of investments, large versus small investments. Again, it was very much a value to be owning small companies during the exact same period. So from 1995 to 2000, you just doubled your money if you just invested in big companies. That's the teal line versus the navy line is smaller companies. Then you just have a complete reversal of fortune from 2001 to 2013. This is often known as the lost decade, but it was not a lost decade if you were diversifying necessarily. But it wasn't just 2 to 1, it was reversed, flipped, and 4 or 5 to 1 in terms of the results for investing in smaller companies. And then 2014 to 2024, it's just been right back to the old ways of 95 to 2000. You can't predict when you're going to have these moments, but what you can be able to do is remain diversified so that you're not overly concentrated in something that could threaten the returns of your portfolio. It's very difficult to predict what's going to be happening next. And it's also very difficult to transition from one regime that is so prolific, so strong, and has been so persistent in our case more recently, to the new regime, which values a different type of investment. So I can't tell you when it's going to be pay off to have exposure to smaller companies, to have exposure to value, or what we're talking about next, have exposure to international. But what I can tell you is the investment lessons I've learned is that having exposure to all of these things and not putting all of your eggs into one basket can be really critical. It's really easy to look at the returns of the last 40 years and the returns of the last 10 years and say, I should just have everything in the S&P 500. Why get it different than that? But I will tell you, if you started investing only in the S&P 500 in 2000 or 2001, that would be a very challenging way to be invested for an early retiree. And it's just like changes your investment behavior over time. And so here's the same story when it comes to international. You may assume US has it all figured out and the rest of the world just needs to catch up when it comes to capitalism, companies, investing, corporate structures, etc. But when we look over time at history, there have been both time periods where the US has been better and time periods where international has been better. We have been on a persistent time period since 2008, 2009, where the US has outperformed international. But there were extremely strong time periods in the 80s and 90s and the early 2000s period that I just mentioned before, which I think is very interesting and informative, maybe not repeating itself, but perhaps rhyming with today, where international did outperform. And of course, international companies are selling to us in the US and vice versa. So in terms of domicile, it's not necessarily a story of just, you need an economy growing in Europe in order for international companies to outperform. But again, keep in mind that there are significant time periods where there has been really strong results when it comes to international. Now, another interesting phenomena that continues to present itself is that the market is outperforming much of let me say it differently, much of the results of the investing market, especially in the S&P, are coming from a very small concentration of companies many of them are very tech forward. They are selling technology to all of the rest of the companies in the world. And they have become a huge part of our indexes. So if you look at this on the top left, the holdings in the S&P 500, which if you're a bigger company, you get to have a bigger portion of the S&P. You've got Microsoft at 7%. These numbers were as of May, so NVIDIA is probably higher or is higher today than it was in May. Apple is 6%, NVIDIA is 6%. 4% to Amazon, Meta 2.5%, Google at 2.5%. another Google at another 2%. And then you have Berkshire Hathaway, the first company that might be considered a little bit of a value company, rounded out by Eli Lilly, which of course is Ozempic wave, and then JP Morgan Chase, which is our largest bank. So interesting. This is a very high concentration of the biggest companies being a huge portion of the S&P 500, which has worked out fantastic for investors because the seven biggest companies have really dominated when it came to returns, and you have that concentration in this cap weighted index, so that you're getting a lot of exposure. I've had a client that worked with another advisor before coming to us this year, and they asked that advisor, hey, I want some exposure to AI. Well, guess what? If you own the S&P or the NASDAQ index, you're getting a lot of exposure to AI because of this concentration in these companies that have dominated as the economy has taken in the possibilities that we didn't know at least widely existed for use cases just a few years ago. Looking on the right, though, it's also interesting. This is 2014, and I know the numbers are small, or the letters are small, so I'll just tell you some of the names of the companies, because this is what everything looked like in 2014. And I remember 2014. I can tell you that we were in a fracking boom, and energy was going to be the new Renaissance story for the fueling the U.S. economy. Apple was the biggest company, so they've continued to grow bigger, a huge success story over the last 10 years. Meanwhile, ExxonMobil, they are not a huge success story. They were 2.5% of the index, the second biggest company in the index. They've been the biggest company in the past, kind of falling from that top. Their returns over the next 10 years were 5.6%. That's the chart in the bottom right. Wow, stunning, because they're underperforming the S&P by 7% per year over that next 10 years. You've got Microsoft, that's another great story. But then Johnson & Johnson is number 4 in the S&P over the next time period, and Johnson & Johnson only returns 6% over the next 10 years, whereas your index returned almost 13. General Electric is the next company, doesn't exist anymore. So that was a toughie. It had been the biggest company in the 90s and really the truest growth story, the company that everybody wanted to emulate. Leadership books were being written about Jack Welch. And then you have Chevron, another energy story. Berkshire Hathaway, they stuck around. Good job, Warren Buffett. JP Morgan Chase, again, still in the index, and Procter & Gamble has done well. They almost matched the index, but they only returned 11%, whereas the index over that time period returned 13%. So we've got several growth stories that really worked over the next 10 years. Apple, Microsoft, JP Morgan. And then we also, though, have some stories that just were lackluster over the next 10 years. And finally, we just have some companies that just completely went away. I think that's a story for the value of indexing, the value of diversification, and also cautionary when it comes to some of the concentrated positions that many of our clients and technology companies have and appreciate, because it's been such a fuel to the fire of wealth creation over the last 10 years. But there's more and more equity compensation that's out there, and that equity compensation going into companies such as NVIDIA, Microsoft, Apple, plus people that are have independently purchased these companies. It's a reminder that you can't assume that the narrative of the past, what's happened in the past, the history, is going to be what happens over the future. And it's nice to take some chips off the table and go back to that diversification story. NVIDIA became the 12th company to be the largest in the S&P since 1926, last month on June 18th. And let's look back at some of those other companies. AT&T, at one point in time, that was the technology story of 100 years ago, and those companies broke up and really don't exist in the same function today. Apple has been a great growth story. Cisco Systems was the NVIDIA of the late 90s, and definitely had the highest of highs. It still exists as a company, but really challenging from those highs for the next 10 or 15 years. You've got your DuPonts, you got your GEs that are gone, General Motors. We know that story for many of us because we're based in Michigan, declared bankruptcy after being the largest company. Philip Morris, has a story of tobacco and tobacco lawsuits. So just trying to inform you about, kind of waves of both huge wealth creation and the important lessons of diversifying can help you to maintain the wealth that you've grown and created through great individual stock investments. Okay, I spent a lot of time there. And, this is another just reminder, why not double down on companies that become the biggest? Because there's just so much interest in a company like NVIDIA, Microsoft, which has a huge AI story, Google, Amazon, and Meta. And this is the returns before on the left-hand side in the green versus returns after. Now, this is averages. So many of these companies have been very good over time. But on average, when you become the largest company, 10 years later, that company is down by 1.5% in terms of their performance of they're performing 1.5% worse than the average company. And this data set goes back to 1927. So they're not negative performance, they're just underperforming their peers. And so, I'm not saying you can't have exposure to any of these companies, but good, healthy practices of diversifying and or sell criteria when you reach higher highs when it comes to single issue stocks is great investor behavior. Oh, switching gears, bonds are a much more frustrating story than the exuberant returns that we've seen in stocks over the last 1, 5, and 10 years. Bond yields remain upside down. And what does that mean? Well, if you borrow money for 30 years, you pay less in terms of the yield, at least per using US Treasuries, than if you borrow money for a month. And this is just the complete opposite of what tends to happen. So if you look on the far left side of this chart, you see the light blue line represents the 30-year Treasury. And that line is at the very top. You pay the most to borrow for the longest, or to lend money, I should say, for the longest. And you get paid the least to lend money for the shortest period of time. And we've been flipped for a couple years now. This is very unusual. What it tells us is that the markets are predicting that interest rates will be down over time. I think the most important question is when, because we started the year with many financial institutions that were making predictions that were probably not realistic in terms of knowing specifically when the Federal Reserve would be lowering interest rates. And it's just like predicting stock returns in the future is I consider it a fool's errand. Maybe you have to do that for your summaries and reports to be, kind of a Wall Street firm, but it just doesn't result in a lot of accuracy when you look at the records of performance on predicting when interest rates will go down. So we don't talk about it a lot. We'll just observe that the markets in general have this inverted yield curve. Though I should say it's quite interesting that we can also see the change from yields being flat and low and historically low going much of the last decade to we've broken out to much higher ranges in terms of where interest rates are. This is not fun when you're a borrower, but it's important when you are an investor, especially for retirees that want to have not all of their exposure for their portfolio in the stock market. When you have a higher yield, there's room for interest rate cuts to impact the returns of your bond investments, which is very useful if or when, of course, over time, we go into the next recession or bear market. So both of these things I think are good, but that's where we're at when it comes to bonds. Now, of course, we have to get through an election in just a few months. Time is counting down. If the candidates remain as they are supposed to be, which we'll find out, I guess, out after the summer, if Trump and Biden are on the ticket, as we believe that they will be, we have had an election day after for each of them. And here's what actually happened. I think I've talked to people who preferred either candidate. to win, and their preferred candidate did not over the last 8 years. And the assumption would be that, the wrong candidate in the office is going to pull apart our economy and our investments. This is an assumption that everybody who has a preference, which is most of us, this is an assumption that everybody assumes, just naturally, inherently. It's part of, kind of the kind of fear-driven part of your amygdala. But the reality is for both, over the next day and 2 months, the markets were positive in both of the last elections. There was a lot going on outside of, only politics in those time periods as well. But I like to tell people, and you can call me on it if you don't believe it, but this is what I believe, that the markets do not care who is president. If you were to look, this is data from Y Charts, which is our investment research tool, over candidacies or presidencies, I should say, going back to 1961. So we have from Kennedy through Biden. Looking back, markets were higher on both sides of the aisle. But the most important thing is to remain invested through the markets, at least if history is a guide. When you look at it, if you stay invested through markets with both leaders versus sitting either a Republican president or a Democratic, sitting out the presidency of one or the other, you have 8% return if you remain invested going back to the 1950s, versus if you only invest when Republicans are in office, it's only 3%, or when Democrats are in office, it's only 5%. It is not Republicans' fault that they're losing in this. They had George Bush got the pleasure of unwinding of the dot-com bubble, plus the pleasure of being the president during 9/11. And then you have the COVID crisis for Trump, Nixon, and Ford had inflation in the 70s. The story is not about either party, and this is what going back to my kind of touchstone, which is the markets don't care who's president. We will talk about tax policy over the next coming months. This is more in our financial planning presentation. Certainly going to be important discussion at our year-end planning webinar, because it really is going to matter a lot who's running Congress. But I would predict that it's unlikely that either house is fully in control of one or the other party. The margins have been quite slim between the two, and no one has been foolproof when it comes to control of the Senate without the filibuster for a long time. And typically, if a Democrat is in president and there's a divided house or controlled by either party, things tend to be positive. Looking back at a Republican president with Democrats in charge of the houses, again, this goes back to the stories of difficult external circumstances, not great, at least historically for Democrats, but it's interesting, divided houses, not getting along and not getting things done, anecdotally tends to be quite positive when it comes to the markets over the last almost 75 years. This is the wisdom that I was told about, and I don't see any particular party being able to run a full agenda without some oversight from Congress. So just a note on that. But it matters a lot about Congress because tax policy isn't just like dictated from the presidency. Okay, so I want to change gears and remind you, actually, we're going to go into some important investing lessons, but especially I wanted to keep this part in the election conversation. Focus on what you can control and don't go into a death spiral when it comes to your investment portfolios and decision making, regardless of who you're frustrated with when it comes to politics, whether it's federal, national, state, or local. And so I just saw this information about the effects of exercise on depression rates. And wanted to remind you to breathe, get outside, take a walk, call us when you need to talk about, and if you're in kind of a stress spiral, because I know so many people are feel like they need to take action based on what's happening with politics in terms of how they manage their money. And I just want to remind you that we're a resource, whether it's listening again to a presentation like this or having a conversation one-on-one with us about what you're feeling, what your concerns are specifically, and then we can talk through the implications of your investment portfolio. But please, also dance, walk, jog, do yoga, talk to a therapist, move your body or take a break from the screens and the algorithms that are pushing you to be fearful. Okay, so let's talk about some important investing lessons. These are more age-old. Some of them I talk to you about every time, but they're important for me to remember, so I'm sure they're important for you if you're open to it as well. The first is I always like to remind you to take your pulse. So each of us is probably a different emoji on the emoji guide to investing. How are you feeling today? Are you maybe feeling differently when it comes to the economy versus your investments? Are you feeling like, oh, there's money to be had, I want to put all the chips on the table? Or are you feeling more like angry, despondent, depressed about the economy? The successful investor, at least in terms of their actions, has more of that flat, straight face, which goes through with the process and doesn't either, kind of over risk when things are feeling great and under risk or stop their process when things are feeling poor. So just take your pulse, take your pressure, and let us know how you're feeling when it comes to that, or let yourself know, I should say. And then, remember that patient investors are really rewarded when it comes to the long-term returns of the market. So this is a look at the returns of the S&P 500 over, this is going back to 1989. The returns of smaller company stocks, which for much of that time period were kind of neck and neck with the S&P, but have fallen off, as we said. Perhaps there will be some mean reversion at some point in time in the future. Interestingly, stocks are long-term are a really strong antidote to inflation. And you can see the US inflation rate at the very bottom in the dark purple, or it may look black to you. The US inflation rate was 2.66% going back to 1989. It's been higher. You can see a slight uptick more recently. What was the best antidote to that inflation? Well, over this time period, at least, it was stock returns. And then you can also see short-term money. It's great to have patience so that you get to participate in these extraordinary compounding events over time. It's also really important to value process. In terms of process, that's staying invested, even on days that feel the most challenging. I remember March of 2009. It was just really dark and depressing because we'd had more than a year of just really, really bad news in difficult markets. And the losses had been stunning. It was just a really easy time to stop being an investor versus to stay invested or start investing. And that moment in time was a generational opportunity when it comes to choosing to invest or choosing to stay invested. The same, and so you can see if you had just sold everything at market lows in 2009, March 9th, 2009, you'd be sitting there having invested $100,000 in 2004, and you would be sitting with $76,000. So a 24% loss, just putting all that money into a money market. Alternatively, if you had stayed invested, you would have $700,000 more than that if you were just in the S&P. Versus if you had just chosen to not be invested for a year, which is really easy to be like, I'm just going to wait until things feel better, then you would have $400,000. So remember the process. It's important to stay invested. And again, when you look at the chart on the right, missing the best days in the market, which are difficult to predict and often accompanied by really difficult times all around. Oftentimes the best days come as bounce backs from really bad days. You can really lose out on returns. The bottom right is, or the far right of this chart is missing the best 50 days in the market over a period of almost 25 years. And if you miss the best days in the market, by the 50 best days, you'd have negative returns, whereas you would have up 8% if you'd been there for all the days. I saw this. There's a speech going around from Roger Federer, and he talks about lessons from his tennis success. And gosh, I was stunned because his numbers really match the lessons of an investor. Federer said, in tennis, perfection is impossible. In 1,500 singles matches I played in my career, I won almost 80% of those matches, but I only won 54% of my points. In other words, even top ranked tennis players win barely more than half of the points that they play. Wow, stunning. Because when you, and I recommend listening to the whole speech, but when you look at this bottom chart, this is the 3 month price returns of investments. And it feels more like a lottery ticket in terms of predicting what returns are going to be. It's just like every day is different, and you don't have persistence of any kind of themes if you just look at short periods of time. It would be even wilder. It just would be hard to even show you of ups and downs for daily returns. But when you look over longer time periods, it starts to be more like Federer's matches and games rather than points. Because there is more persistence when you stay invested longer. It turns that lottery ticket or casino visit into something that is more predictable. And certainly, you are not guaranteed any amount of returns over time, but returns tend to become more predictable. 20-year annualized returns for the S&P going back to 1970 have an average return of 7%. 10-year returns have an average return of 7%. 5-year returns have an average return of 8%, but 3 month returns are only averaging 2%, and you can definitely have more periods that are low. And so this is certainly important information for us to understand. When it comes to withdrawal rates too, I like to remind you that focusing on what you can control means to manage your financial planning affairs and not just the investment environment, which is less in your control. And this is just a reminder of saving more, and having a little bit lower withdrawal rate in retirement can really preserve capital in a portfolio and keep your balances higher. So the look on the left is a 4% versus 5% withdrawal rate. If you withdraw 4%, you start with a portfolio of $1 million, that's 50-50 stocks and bonds. You have $1.5 million at the end of the period. You have $900,000 if you would withdraw at 5%. This is over a 20-year period. But then if you're comparing 4 versus 6%, you really have, again, the 1.5 million when you were withdrawing 4%, but you're down to 360,000 when withdrawing 5. And as we know, 6, we know most people are planning to be retired for longer than 2 decades. And then 4 versus 8%, you just typically end up running out of money with 8% withdrawals after 15 years. So do focus on other, kind of rates, and just a cautionary reminder that it's not just what markets are doing, it's what you are doing, your behavior, both in savings and withdrawals and investing in withdrawals. The Olympics are coming up, and it was as I was watching with my kid who's obsessed with ancient Greece and really likes the Olympics because the Greeks did it too. This is the Percy Jackson influence. I was reminded of how quickly things have changed over time in other areas, not just markets. We're experiencing, I think, kind of a revolutionary wave in terms of the economy and investments when it comes to technology and artificial intelligence. That doesn't always predict that returns will be just through the roof, as we learned from the dot-com bubble. But do be aware as a pessimist that when you're a pessimist, or when you are looking at the market, looking for reasons things can go wrong, you're probably not factoring in surprises on the upside. And here's just 3 examples. Go onto YouTube and look at a video of Olga Korbut, who was the best ever gymnast of her time, and look at what she was doing in gymnastics compared to Simone Biles on the floor, doing flips that have her tiny muscly body going 12 feet above the ground when she does her tumbling runs. And look at the difference between what was possible 50 years ago versus today. Michael Phelps' last individual world record for swimming fell more than a year ago. And this is the best person ever when it came to being an Olympic champion. But world records tend to fall. Some do hang on. But the world is constantly constantly being expanded, and it's difficult for us to factor that in. Or look at this tweet from last June, just talking about it's blowing my mind that these two pictures of on the left, someone in early flight versus on the right, a sonic boom, happened in the same century. It's just difficult to predict. And that is one of the reasons why it pays to kind of start from an optimistic frame of mind. And thank you for allowing me to kind of share some things that are, good examples to me that are outside of investing. Our town just experienced its bicentennial, so more than 200 years. And I was sitting, the picture on the right I took during the bicentennial celebration. You can actually see our building in the background where our office sits. And it's looking across the street at this park where there's a monument for those of you who haven't been here. And I saw this on Twitter from the University of Michigan Bentley Historical Museum honoring Dexter's bicentennial. I think that's the same park. And this is a picture from 150 years ago. So it's probably from the 1880s. I said 1890s. But you can see horse and buggies on the same street. And just think about the possibilities and what has changed over that period of time. And it would have been very difficult to predict what the world would look like for someone who was sitting in the 19th century. And I think that's part of our optimism. Maintaining perspective beyond what you are seeing. You see the rhinoceros where every point of view has this, nose in the front, but that's not a 360-degree view of the world. And I love and continue to use this cartoon that is constantly shared by Michael Antonelli, an investment guru from Baird, showing the person who is prepared for rain, looking on the TV to see the forecast of rain and missing that it's a beautiful day outside. This is very translatable for those of us who invest because it is so easy to get mired in the challenges. Oh my gosh, we've gotten to the end of the presentation. I talked a lot today, but I really felt like there was a lot that we needed to talk about. There's still room. I'm going to go through, we have a webinar coming up for college savings, and I encourage anyone to listen in to our Women's Money Wisdom podcast, which can be found on our website. Visit us and reach out if you have any questions. And I have to make sure to include my compliance information, and here's our contact details.